All right, we're going to start off with the age-old question that I hear more often than Trump calls Powell a moron. And just like Powell, my answer changes every week depending on which economic dumpster fire is currently burning. So, hey, Mike, what are the rates? Well, according to Mortgage News Daily, as of August 25th, 2025, the 30-year fixed conventional mortgage rate is around 6.52. The average 15-year fixed conventional rate is about 5.90. The average 30-year FHA rate is about 6.11. The average 30-year VA rate is about 6.13, and the average 30-year jumbo rate is sitting at around 6.50 right now. Now, to be clear, these are average market rate index numbers from Mortgage News Daily and may not reflect the specific rates that you qualify for. Mortgage rates vary widely depending on your credit score, loan type, down payment, and more. So talk to a licensed mortgage professional like me or your local lender. All right, CFPB approves, though I think these days they're down to like 5 employees in a fax machine, but anyway, so as of this weekend, it finally feels like we're starting to move in the direction that everyone in the real estate industry has been hoping for the last 3 years. Rate cuts are coming. Now, what happened last week? Well, the Fed held its annual meeting at Jackson Hole, Wyoming. And this meeting isn't just where they decide what to do about rates, but it's ultimately held to foster open, in-depth discussions among central bankers, policymakers, economists, and thought leaders about pressing economic issues and long-term policy changes. In reality, this is just another spot that elites get to have a meeting in a really awesome location and decide how the rest of us are going to continue to give them all our money 1 percentage point at a time. But I digress. So before Powell spoke on Thursday, the CME Fed Watch tool, which predicts the odds of a rate cut, had it at about 76% that it would happen in September. But after Powell spoke, the odds went up to 89%. So it wasn't a sure thing, but it was for sure much more likely. So what caused this change? Well, first you have to understand that the Fed has what's called a dual mandate: price stability and full employment. So most of the factors that help the Fed make up their mind on if they plan to cut rates or not come down to inflation and unemployment numbers. So typically, if inflation is high and or unemployment is low, then rate cuts are unlikely. But if inflation is low and or unemployment is rising, then rate cuts are more likely to occur. But right now, inflation is still rising in many cases. And at the same time, the labor market is getting weaker. And this is all based off the latest CPI and employment data that we got from the BLS. So we got inflation numbers that are suggesting rates should remain high, but a weakening labor market that indicates that the Fed should start to look to cut. So Mr. Powell's in kind of a pickle right here. You see, in early August, the jobs report came in so bad that the CME Fed Watch tool instantly priced in a 94.9% chance of a September rate cut. Why was this? Well, the job revisions in that report were catastrophic. You see, May jobs were revised from 144,000 down to just 19,000. And June jobs were revised from 147,000 down to just 14,000. That's over 250,000 jobs in 2 months. That is massive. And then the July jobs report that expected to come in at 120,000 jobs only came in at 73. And given the job revision history, it is very likely that those July numbers will also be revised down as well. And they may even go negative in jobs created. So that's not just a slowdown, that is the labor market falling into a ditch. It was so bad, in fact, that Trump fired the commissioner of the Bureau of Labor and Statistics. Now, right or wrong, BLS data has felt a little sketchy ever since COVID. And it's either hiding information or it's really running broken algorithms. Now, I'm not saying the commissioner deserved it, but Trump went full Apprentice 2005 all on her. You see, he was fine in the past when the revisions made Biden look bad, but the second it hurt his own economy, boom, you fired. Now, Wall Street, of course, cheered like a bunch of tweens at a K-pop concert because bad jobs data means cheaper money, because at that point, rate cuts were basically baked in. But then the inflation numbers strutted in like Thanos, ready to ruin the party. You see, core PCE, and that's the Fed's favorite measure, stalled at around 2.9 to 3.1%, absolutely refusing to go down. And many feel that the tariffs were responsible for this. And after that, suddenly the national narrative flipped. Instead of rate cuts are a lock, it became how can the Fed cut rates with inflation still raging on? And although it did increase slightly, it didn't really move beyond what the expectation was in the inflation data before it came out. So the Fed, looking at those numbers because they met expectations, seemed to have less of an impact than the jobs report numbers, which ultimately are the main focus right now. And at that meeting, Powell even stated that inflation was expected to rise and possibly just a one-time blip on the radar because of the tariffs that were imposed, meaning that it's expected to be very short-lived and not that long-lasting. And he also stated that he felt the labor market was more important to the overall health of the economy and therefore could possibly warrant a rate cut. And so after that meeting on Friday, you saw all the asset prices spike up with the expectation of looser monetary policy on a go-forward basis. And all that just means that markets expect cheaper money coming our way very soon. So will the Fed cut rates in September? Well, as of right now, everybody's pretty much betting on that. And markets, of course, are reacting accordingly. And that is why you are seeing now in the bond market more money moving into mortgage-backed securities. Therefore, mortgage rates are starting to inch down into the mid to low sixes, and in some cases, even the high 5% range. So what do we tell our clients based on this information? Well, for buyers, let them know that rates are coming down, but don't assume that this is going to continue. It could absolutely for sure. But we also just added another $1 trillion to the national debt over just the last 48 days. And mortgage rates also tie closely to the 10-year treasury yield. And as debt increases, so does that yield and can cause mortgage rates to go up. So the rate cut will give some relief for rates for sure, but it may not last very long. So encourage them to take advantage while they can. But if rates do continue to fall, demand for housing could also heat up pretty quickly, meaning that home prices may actually rise and offset the benefit of slightly lower rates. So the waiting for rates to drop further strategy could backfire if the market suddenly surges. So remind your buyers, if they can afford a home right now, locking in today's price could be smarter than gambling on tomorrow's rate. And for sellers, well, in Texas, inventory is definitely higher than it was last year, but still not enough to push prices down in any meaningful way. And so a lot of would-be sellers are sitting on the sidelines because they also have to buy. But there's a catch there, because if rates do slip, demand could spike and again drive prices higher. And that sounds good if you are only selling. But if you also need to buy, waiting could mean paying more for your next home. Plus, once rates do ease up some, more listings could also start to flood the market from those sellers that have been waiting, creating more competition for their property. So listing now, or at least just getting ready, positions your sellers ahead of the wave. Now, looking ahead, all eyes are going to be on the Fed's September 17th meeting, but the expectation of a cut will already be baked into the market by that time. Once the meeting actually happens and they announce the rate cuts, in a weird, crazy way, you could actually see rates tick up a little bit. Look, I've been tracking this stuff for 15 years, and often when rate cuts finally are officially announced, rates tend to tick up a little bit because that expectation was already priced into the market, and so therefore the market adjusts back in the other direction some. But the Fed's next meeting is basically the season finale of this year's monetary soap opera. Will they cut or will they hold? Either way, the decision is going to set the tone for mortgage rates headed into the fall. And you know what? Trying to predict where rates are going to go is like trying to predict my 17-year-old daughter's mood after a long day of school. It's unpredictable, potentially volatile, and dangerous if I ask too many questions. So the best strategy is just let it play out and adjust your expectations accordingly. Because right now there is a ton of uncertainty out there, conflicting data, political posturing, and global conflicts. It is absolute chaos. So I don't know exactly where rates are headed, but I do know this. All you can control is you. So position yourself as the go-to realtor in your market. Because when people do decide to move, and they will, and it's often all at once, you'll be the one ready to serve them. So build your processes, market your ass off, and be ready for when the phone rings. Because we could be on the verge of this housing market turning a corner, which means Christmas could finally come for all of us surviving Tiny Tims in this post-COVID housing market. So stay ready and make sure that you aren't a secret agent that no one can find when they're ready to pull the trigger. And just one final note on this. As rates come down and debt continues to explode, the safest place to have your money right now is in assets. Stocks, bonds, heck, even crypto. And yes, of course, you guessed it, real estate. Because as cash is devalued, assets will continue to go up in value. And if you want to protect your wealth, an appreciating asset like real estate isn't a bad place to store your cash. Just saying.